We are committed in our focus on analytics to ensure our model remains agile and scalable. Our approach blends the physical and digital touchpoints, catering to customers who are still adapting to evolving technologies. In the last quarter, our company consolidated disbursement amounted to rupees 1767 crores, showing a significant 31% sequential growth. At the beginning of the year, we set out to decrease our gross NPA numbers, and we have actively pursued this goal. With aggressive collections, excellent credit appraisal and control measures implemented, we have been able to reduce delinquencies, which have been aided by a vibrant economy. We have been able to reduce the GNPA on a consolidated basis to 4.1% and in the standalone entity to 4.97%. In FY24, we also successfully executed our strategies of moving towards retailization by selling a part of our corporate portfolio to an ARC, which is now standing at rupees 388 crores only. Additionally, we have reduced our high-ticket SME portfolio to 485 crores through strategic sales to an ARC, minimizing the risk and fortifying our financial position. These initiatives have also contributed to improvement in our NPA ratios. We have been strengthening our financial stability and enhancing our balance sheet quarter after quarter, and this momentum will continue going forward. We are expanding our retail operations with a particular emphasis on the used commercial vehicle segment, focusing primarily on Tier 3 and Tier 4 markets. We are dedicated to scaling up our operations to drive growth while maintaining asset quality. Our goal is to sustain progress in profitability by steadily increasing our targeted return on total assets. Looking forward, we anticipate steady growth in the used vehicle segment. With the EMI of new vehicles exceeding lakh of rupees, used vehicle EMIs have become more affordable, leading to a significant rise in the demand for BS4 vehicles. The transition from BS4 to BS6 has further fueled the demand with a notable price differential of 25 to 30%. We anticipate the used commercial vehicle pricing to remain at similar levels in FY25-26, particularly with the entry of BS6 vehicles into the resale market. The introduction of technologies and the introduction of FASTag and the removal of octroi and check posts have expanded the lifespan of assets, consequently increasing the resale values. Moreover, there is a significant uptick in the resale of BS6 vehicles due to improved technical performance. We expect robust growth in the used CV space with the entry of these new vehicles in the FY25-26, driven by their ability to transport same volume of goods at lower ton per cost and reduce downtime. Furthermore, the useful life of CVs has increased, allowing NBFCs like us to fund up to 12-year-old vehicles. Our ability to collect payments has remained exceptionally strong, reinforcing the resilience of our business model and trust the customers have in us. Our strategic direction remains unchanged, and we are actively exploring new products and strategies to enhance returns and generate additional income. Diversifying our product range will ensure we maintain our competitive advantage and constantly deliver to our stakeholders. Now I will hand over the call to Mr. Vinod Panikkar to present the financial performance.
Good afternoon, everybody. Thank you, Karthikeyan. I sincerely appreciate your presence at this conference call today. I intend to take you through the financial performance for the quarter ended and the full year of FY24. On a consolidated basis, we generated a total revenue of 474 crores in the fourth quarter, as against 285 crores in the same quarter last year and 306 crores in the immediately preceding quarter. The operating expenses incurred were at about 139 crores in the fourth quarter, as against 66 crores in the same quarter last year and 119 crores in the immediately preceding quarter. The disbursements were at 1767 crores, as highlighted by Karthik for the fourth quarter, as against 898 crores at the same time last year and 1,345 crores in the immediately preceding quarter. At the consolidated level, the AUM was at about 8763 crores as of March 24, as against 7813 crores in March 23, and it was at about 8037 crores as of December 23. On a standalone basis, we have generated a total revenue of 391 crores for the fourth quarter, as against 236 crores in the same quarter last year and 238 crores in the immediately preceding quarter. The operating expenses were at 112 crores for the fourth quarter, as against 45 crores for the fourth quarter last year and 91 crores in the immediately preceding quarter. This 45 crores in the same quarter last year was net of a 50 crore reversal of ESOP, which we had mentioned at that point of time. The disbursements were at 1,465 crores for the standalone entity for the fourth quarter, as against 715 crores in the same quarter last year and 1121 crores in the immediately preceding quarter. Against the same quarter last year, the growth has almost doubled or more than doubled. Our interest margins for the quarter was at about 5.4%, and for the full year, we were at about 5.5%. The revenues of the standalone includes a one-time gain of about 96.6 crores on account of sale of SRs in the fourth quarter, the proceeds of which was utilized for strengthening the balance sheet by creating additional provision on the loan book and the SRs. The revenue also has a new component, which is revenue from cross-sale of insurance, for which we have got a corporate agency license in February 2024. We are confident that this will help us generate significant income in the quarters and the years to come. On a full year basis, the overall revenue at 1104 crores was higher than the 968 crores in the last compared to the last year. The disbursement was at on an overall basis was 4,560 crores against 1,612 crores, a growth of about 183%. The AUM at 6,493 crores as of March 24 was after sales of the corporate book, which Karthik mentioned, and the SME book, both the delinquent one and also the standard book. The delinquent one overall was at about 1175 crores, and separately an SME standard portfolio of about 143 crores was sold to another NBFC. All these steps were taken to ensure that the balance sheet becomes clean, the business yields go up, and we get more and more retailized as we go forward. The finance cost for the quarter at 161.9 crores was against 134 crores in the same quarter last year and 145 crores in the immediately preceding quarter. Turning to the operating expenses, it stood at about 112.3 crores in Q4 FY24 as against 45.8 crores in Q4 FY23 and 91.2 crores in Q3 FY24. As I had mentioned earlier, the Q4 FY23 cost had a reversal of 50.5 crores, which was a one-time impact. On a full year basis, the operating cost was at about 389 crores versus the 327 crores that we reported in FY23. The operating expenses are seeing some increases mainly on account of the company ramping up the number of branches and also the number of employees to drive the growth in the CV and the HFC business. Our profit after tax for the fourth quarter, the standalone profit stood at 19.6 crores and on a full year basis stood at about 71.6 crores. We achieved a total collection of 700 crores for the current quarter as against 632 crores for the immediately preceding quarter. Our collection efficiency, including overdue, reached 101% in the current quarter, showcasing our commitment to high credit standards and high operational efficiency. Our focus on portfolio quality has led to has decreased in the gross stage 3 assets to 4.97% at the end of Q4 FY24. Furthermore, our net stage 3 has gone down to 2.1%, again demonstrating the effectiveness of our credit risk management strategy and improvement from 2.8% in December 23. The reduction in the GNPA numbers is on account of the robust collections that we have seen on the loan book and the aggressive settlements that we have done on the old book. That is the book which was generated prior to April 22. This will ensure that the lower stress book will also lead to better, I would say, funding in the coming quarters. The credit cost stood at about 102 crores, which was mainly on account of additional provisions that we created for SRs and on the loan book. In terms of funding, we have made steady progress in improving the liquidity position by raising the incremental funding in the fourth quarter by about 1,609 crores. As of 31st March 24, we maintained a cash and cash equivalent of about 836 crores. The change in the mix over the last 2 quarters has helped us reduce the cost significantly as we moved from an incremental borrowing cost of 12.7% in Q2 FY24 to 10.6% in Q3 and 10.9% in Q4. With the improved GNPA numbers that we mentioned above, we are confident that the costs will continue to go down further. Our capital adequacy of 28.9% and the debt equity ratio of 2.3 gives us ample headroom for further future growth. And we are confident in driving profitable growth in the quarters and years to come. Our asset under management of 6,493 crores as compared to 5,991 crores of in the immediately preceding quarter shows that there is an increase. The increased disbursement of 1,465 crores versus the 1,121 crores of the preceding quarter can be attributed to our strong focus on retail segment. Retailization will continue to yield favorable results, and we are confident of sustaining profitable growth in the quarters to come. In the vehicle finance segment, our AUM at the end of the fourth quarter stood at 5,594 crores, marking a 15% increase over the immediately preceding quarter. As previously mentioned, our emphasis remains on growing the used CV segment, and we are experiencing significant growth in the AUM, which we expect to continue. Now I would like to invite my colleague, Srijit Menon, to provide further insights into our housing finance business, which is another key focus area of our business. Over to you, Srijit.
Thank you, Vinod. Good afternoon, ladies and gentlemen. I would like to start by taking you through the key highlights that illustrate our accomplishments during the quarter and year ended March 31st, 2024. The financial year gone by has been a period of remarkable growth for us. We are delighted to report that we witnessed strong momentum across most of our business matrices. During the quarter 4, we reached an important milestone by achieving a monthly disbursal run rate of INR 100 crores for the first time. The total disbursal for Q4 FY24 amounted to INR 301 crore, contributing to a total disbursement of INR 937 crore for the full financial year. Our assets under management reached INR 2269 crores, representing a robust growth of 40% year-on-year and 11% over Q3 FY24. Our loan book stood at INR 1,817 crores. Our customer base now stands at more than 28,000, depicting the granular nature of our assets with an average ticket size of INR 9 lakhs. Tamil Nadu, AP, Telangana, and Maharashtra continue to remain our core geographies, accounting for more than 85% of our portfolio. To enhance operational efficiency and embrace digital transformation, we undertook the rationalization of our branch structure with introduction of a 3-tiered, full-fledged, integrated and digital branch structure. This has resulted in a more efficient branch operations from both volume and cost perspective. We converted 10 of our physical branches into digital locations during last quarter. Hence, at the end of the financial year, our total branch count now stands at 124. I'm also pleased to inform that at Indostar Home Finance, we've always believed in maintaining excellent asset quality, and that remains a cornerstone of our operations. Our 90+ days past due portfolio now stands at 0.83%, and our 1+ DPD stood at 3.02%. Furthermore, our GNPA decreased to 1.13% as of March 31st, 24, down by 0.12% compared to the previous year. We are proud to announce the achievement of a significant milestone in our digital journey. In Q4, we completed the transition to 100% digital and paperless loan journey, culminating the journey that we embarked upon from Q2 last year. With the implementation of the automated loan kit, our entire loan process is now paperless, making it hassle-free from a customer experience perspective. On the liability side, we successfully raised INR 1,150 crores during the financial year across our various funding channels. We added 9 new lenders / investors into our borrowing program. We are pleased to report a strong liquidity position with INR 220 crores in cash on the balance sheet and an additional INR 165 crores of undrawn sanctions. Now moving on to our financial performance. Our total income stood at INR 290 crores with interest income at INR 182 crores compared to 209 crores and 144 crores respectively in the previous year. Pre-provision operating profit increased to 63 crores from INR 51 crores last year. Profit after tax rose to 44 crores from INR 38 crores last year. Our return on assets stood at 2.9%. We maintain a strong capital adequacy of 57.4% and a debt-to-equity ratio of 2.6 times. In conclusion, our commitment to innovation, efficiency, and maintaining high asset quality continues to drive our success. Looking ahead, we remain focused on executing our strategic initiatives to further enhance operational excellence, expand our customer base, and explore opportunities for growth. We are indeed optimistic about the future and remain dedicated to delivering sustained value to our investors and stakeholders. Thank you once again for your continued support and participation. With this, I hand over the call to the moderator for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Kudonia from DSP Asset Managers. Please go ahead.
Hi, this is Vivek Ramakrishnan. I have 3 questions. One is on this on your sale where you have via security receipts to ARCs. So I wanted to know how much was cash, because you mentioned 143 crores in cash to an NBFC via assignment, and how much was in terms of security receipts, and whether in any of the security receipts in the past, either in the corporate or the SME portfolio, you started getting recoveries. That's question number one. Question number two is that if I see the liability profile, the bank loans have not increased significantly. It still remains a small percentage, and that somehow seems to be linked to your credit rating, so there's still a AA- with a negative outlook from one of the rating agencies. So please comment on that. And lastly, there was this ICICI CV portfolio that was causing some volatility in GNPA, whether that issue has been completely settled. Those are my questions. Thanks.
Hi, Vivek. Vinod here. I will possibly try and address the first two points, and I will request Karthikeyan to look at or respond on the third point. There were two separate transactions. One was a sale of an SR. Now that was for a total of 100 crores, of which 60 crores was in the form of cash, 40 crores was in the form of SR, on which we have made a provision separately in our books. On the 143 crores which I mentioned about, that is a DA transaction which is in a 100-0 ratio, wherein we have sold the SME portfolio to another NBFC, and the entire amount, the 143 crores, has come to us by way of cash. You mentioned about the liability profile. Yeah, definitely banks have not come to us in a full way, but then we are pretty confident that based on the number of proposals which are there in the pipeline, two of which are in the final stages, we are confident that in this quarter the bank proposals will come. Definitely the negative outlook of CRISIL is an issue, but then I thought that banks were earlier having some amount of discomfort basis the GNPA that we were reporting. Now that we are sub 5% and NNP at very close to 2%, we are pretty confident that we will be able to give that additional comfort to the lender, including the bank.
Hi Vivek, Karthik here. On the ICICI piece, we have only 114 crore book remaining. We have tightened last time I explained, we have strengthened our collection processes. Now our monitoring has started from the 1 DPD bucket, so the amount of flow that is coming into us has quite reduced. And now whatever is remaining in the books of ICICI is a quite matured book. So we don't see any challenges going forward. It should keep reducing. The quarter, probably a 10 crore increment should come, not beyond that on the GNPA front. That's my view on the ICICI portfolio. Overall, we are very comfortable with the collection. Last quarter in ICICI, we were having a collection of stage 1 of around 87%. So we don't see any major challenges coming in that book.
Excellent, sir. So just one balanced question was in terms of the security receipts from the past in terms of the corporate portfolio or the whether there are any settlements expected shortly.
Yeah, I will split it into three. One is the CV portfolio. There is collections which were coming and they continue to come. So that's the CV portfolio. Both of them are pretty old. One was done in 20, other in 21. On the corporate portfolio, which is the largest chunk, which was at about 686 crores, against which we had made a provisioning earlier of 15%. Subsequently, now we have made a provision of 20%. On that, we have started getting collections. I think we have overall reduced the SRs from about 686 crores to about 644 crores. So collections are coming in, and we have actually, in one of the cases, we actually, the ARC has actually signed an agreement with one of the borrowers to actually collect the entire amount by the end of the current financial year, by February 25. So we are seeing a lot of collections happening on the SR. The SME, that's the third piece, is something which actually happened only in December. We expect the collections or the redemption of those SRs to start only from maybe January of 2025.
Thank you very much, sir, and wish you good luck.
Thanks, Vivek.
Thank you very much. The next question is from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Good afternoon, sir. 2 or 3 questions. The first one is on our recent fundraise. We did a QIP despite being adequately capitalized. So what was the need of this QIP, and where do we think we're going to deploy the incremental monies that we have got? So the second is on the SR. Do we expect any kind of harmonization of regulations around SRs and with banks? And would we have to provide for the SRs, or have we already provided for the SRs that we are carrying? That's the second. And third, we spoke about used vehicles. So what are the specific applications or in terms of SRTOs and slightly larger fleet operators that we cater to, and what would be a no-go territory for us in terms of SRTOs? Any specific applications like maybe alcohol industry or something? Thanks.
Yeah, I'll start off with the third question. The industry question. See, we are predominantly funding the market load operators who depend on agri-good movement. India is a large agrarian country where the movement of agriculture forms the most important transportation across. Plus, there is a lot of FCI goods that gets moved. With the government of India providing free grains to most of the people who are below the poverty line, trucks become a most important aspect of distribution between hubs to hubs, and the products which we fund, like the light commercial vehicles or the small commercial vehicle, take it to the last mile. So that's the most important territory which we are focusing on. We are not in the fleet operator segment, so we hardly do any deals on the fleet operator segment. Our pure profiles are retail FTU who are doing only retail operations or into open goods transportation. A few of the operators will also be in the local infrastructure segment, say like somebody who's attaching a tipper to the local road contractor who's moving, who's doing some activity. That's the major core focus area of us. In terms of no-go, typically these kind of operators don't get contract from alcohol, other things. So we don't see any major challenge in terms of industry or any thing coming here. There are challenges for these operators around the pollution that happens in Delhi around October, November. So during that period, there are markets of North India where all the trucks get banned. That's not a specific issue to my borrower. That's an industry issue. So that's on the third question.
On the first and second question, Subhranshu, actually, I will take the first question. It was not a QIP, it was a preferential allotment to one of the investors that was Torrentry. There was an investment which they wanted to do, and in a name like Torrentry, when they want to invest in the company, when they take interest in the company, we felt that no, it's worth getting such a big name into the company as a shareholder. And definitely, there are a lot of things that we can learn from them. That's one thing. So when they were to do the investment, Brookfield felt that if somebody else comes in, their stake goes below the 56.2% that they were currently holding, so they also came in. Definitely, while we are adequately capitalized, we believe that this additional capital will give a lot of comfort to the lenders. And today, our intention is to ensure that the lenders are comfortable with whatever we are doing. And definitely, Brookfield, by putting in that additional amount, they are showing the commitment that they have for the entity. Number two, a new investor coming in actually gives a lot of comfort to the lenders and other investors also, because it shows that people who have looked at the company, did a due diligence, and then invested into the company. That gives a lot of comfort. That's on the first point. Second point, you mentioned specifically about SR. In my previous response to Vivek, I think I had mentioned about the collections against the SRs have started, and we have been able to recover funds, the monies against the CV SRs and also the SRs of the corporate loan. In the your question on whether we are adequately provisioned, we believe that we are adequately provisioned, and like I mentioned possibly in my initial commentary, that the gain that we got, the one-time gain that we got, we actually used it for creating additional provisioning. We created about additional 75 crores, and today the total provisioning on the SR on an overall basis is at about 31%, which we believe is significant.
Just one last question, sir. Actually, it's a follow-up question. Basically, if I have to infer from your SRTO categorization, we don't have a negative category of customer, PIN code or geography at all. We would just about lend to anyone. Is that a fair?
I'm not saying that. I didn't say that. Sorry. I said like we typically fund market load operators. There are geographies, there are PIN codes where we don't fund the profile, all profiles. So that's the part of the credit appraisal process, depending on our past delinquencies, depending on the kind of vehicles which will not sell there. We have a model wherein, say, suppose a particular location, a particular vehicle is going to give me high delinquencies, we are not going to fund there at all. So those are all internal models which typically we use for negotiating LTV with the customer, ensuring that the bad book doesn't come to us. What we don't do is specialized asset. Some SRTO coming in for a specialized asset. Say somebody wants to fund a bullet tanker. I may not fund. But if he comes for a market load operator in a good geography and the LTV which I prefer, I will surely fund.
Understood, sir. I'll come back in with you. Thanks.
Yeah. Thanks, Subhranshu.
Thank you very much. The next question is from the line of Saptashri Chatterjee from Grow AMC. Please go ahead.
Yeah, thank you for the opportunity, sir. My first question is on the SR. I've already mentioned that overall provision is around 31%, but if you can give bifurcation across books of CV, corporate and SME, what is the total amount outstanding and the provision amount against those?
Saptashri, thanks for being on the call. On CV, the provisioning is at about 60%, and on SME, SME and the corporate is at about 20%. And the last transaction that we did, which is again a CV, so where it's a recent transaction, so there the provisioning is at about 30%.
Thank you.
Overall, it's 30%.
Yes, understood. Thank you. But do you expect that over the quarters, like as we proceed on next year, there will be revaluation of the SR book? There can be volatility in terms of further provisioning in the SR book?
We don't see the need for any additional provisioning, but then I also mentioned against the point that can you I mentioned that there are collections coming from the SRs, and therefore we don't see any challenge going forward. We may not need to make any additional provision.
Understood. Very helpful. My last question is that you have mentioned we are also focused on new products that are coming in the coming years. Can you somewhat elaborate on those, that what are the new products? And on the SME part, like you were mentioning, that we will be launching SME in a new avatar, and like what are the capabilities that you have built against that front? Thank you.
Thanks, Saptarishi. See, on the new products, the allied products of CV like tire, the kind of maintenance funding that is required, these are all in the pipeline because we have a large base of customers who are doing well, who are paying me on time. So those kind of customers will start our tire financing. The new line of business on SME, we are in the planning stages. We should launch it shortly. It will be a loan against property at the rural markets, Tier 3 and Tier 4 markets at a lower ticket size. Probably by the next call, I will give you a detailed thing on what is that we have brought into the market.
Okay, sir. Thank you so much and all the best.
Yeah. Thank you, Dr.
Thank you very much. The next question is from the line of Devansh from Safe Enterprises. Please go ahead.
Yeah, thanks for the opportunity. So can you elaborate more on the liability profile as well as cost of borrowing of individual borrowers? How do you see that mix going forward? Because we were confident on bank borrowing coming in significantly this quarter, which hasn't translated yet. So also you can share your outlook on the same.
Can you repeat, because the voice was not very clear, if you don't mind?
Yeah. So on borrowing side, can you elaborate on the cost of borrowing of CP and NCD banks, and how do you see the mix shaping up over next 1 to 2 years?
See, over the last couple of quarters, we have changed our mix. We have brought in PTC and commercial papers, and therefore our overall cost of funds have actually, the incremental borrowing cost has gone down. Like I mentioned in my initial remarks, that from a 12.7% in Q2, which was incremental borrowing cost, it went down to 10.6% and 10.9% in the last 2 quarters. We are expecting, I also mentioned that with the company starting to do very well, with NPAs going down significantly, we are expecting many more banks to come to us. We are expecting many other lenders to come to us, and therefore we expect the overall cost to go down. We are expecting some amount of, I would say, funding from banks in the current quarter and in the quarters going forward. We expect the cost to come down. I would not want to possibly give a number to it, but then definitely what you have seen in the last couple of quarters, that where the incremental cost has gone down, that will continue to keep going down. Maybe kickstart the business at the beginning of the last financial year, FY2023-24, we actually borrowed in the form of NCDs, and that time banks had not come to us. So our role was to ensure that our job was to ensure that we get funds and we kickstart the business. We kickstart the to run the business, and therefore now whatever we wanted to achieve, we have achieved, and therefore now we feel that the banks will come. The PSU banks, normally they insist on 2 years of profitability. Now that we have done 8 quarters at a trot showing profitability, last 2 years has been profitable, we are confident that banks and many more banks will actually come to us.
Okay. And as on Q4, what is the cost of borrowing for banks, CP and NCD on blended basis for individual, on 3 of them individual?
On a blended basis, the overall cost of borrowing was at about 11.4%, down from about 11.7% in the immediately preceding quarter.
So what I'm trying to ask is, like, for the bank exposure, what is the cost of borrowing? For NCD, what is the cost of borrowing? For CPs, what is the cost of borrowing? And on marginal basis, what are the cost of borrowing for individual?
Devansh, I think we can possibly get on to a call separately where we can possibly get into this nitty-gritty.
Sure, thanks.
Thanks, Devansh.
Thank you very much. I request all the participants to restrict your questions to 2 per participant, in order the management is able to address questions of everyone in the queue. Thank you. The next question is from the line of Rikesh Parekh from Rockstar Capital LLP. Please go ahead.
Thanks for the opportunity. Sir, just a couple of questions. One is, what is the amount of security receipt we hold on our books? And I understand we have 31% provision. So any collections or recovery in this quarter from that book?
Yeah, I think, Rikesh, good afternoon. I think I'd answered this against a couple of queries earlier also, but maybe I will repeat. The total book SRC is something like 1,175 crores, on which we have a 31% provisioning. I also mentioned about collections happening in the CV SRs and also against the corporate loan SRs. I mentioned that SME SR collection could possibly start from January 25.
Okay.
Hello, Rikesh?
Yeah. The second is on our number of branches. I've seen that we have now removed any common branches. We have separate branches altogether. One thing what I found is in the home loan side, the number of employees have reduced while the branches have increased. So anything to look into it as such?
No, actually on the home loan side, the number of branches have come down. We started the year with 134 branches and now it is 124. So we have actually reduced branches. We have not increased branches.
Okay, I might have looked quarter on quarter, so would have come to that thing. Okay. And lastly, on the our gross stage 1 and 2, if I refer to slide number 15 as such, so we are seeing some amount of increase happening on the gross stage 1 and 2. Although gross stage 3 is well under control. So anything to look into it over there?
Pardon? Gross stage 1 and 2?
The absolute figure are increasing the quarterly wise. It's at 5985 crores gross stage 1 and 2. So as of
Q1 increasing is a positive phenomenon only, no? Because the portfolio is being able to, my X plus has come down. I am underwriting better credit because we have introduced norms around what should be the CIBIL score that should come in. Overall, the market is performing well. So my gross stage 1 is moving up. So many of the customers who were in stage 3 have also got upgraded. That's why the gross stage 1 and stage 2 are moving up.
So, and we expect this line to improve going forward. So I just wanted to understand that.
We are pushing for a positive gross stage 1 and stage 2 number.
Okay. Thanks. That's it from me.
Thanks, Rikesh.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yeah, you are, Deepak.
Sir, on the OPEX side, I just wanted to have some understanding. I think this quarter, our OPEX was close to about 140 crores. So how do we see that OPEX growth in FY25?
It would be a normal one because I don't think it has gone up significantly versus the last year because on a full year basis, 140.
So on a full year basis, your OPEX is up from 400 crores to around 490 crores amount. Yeah.
You are referring to the consolidated?
Absolutely.
Give me a second. Yeah, from 401 to 492. See, I think in my initial call, I had initial commentary. I think I had mentioned that there was a one-time ESOP reversal last year. Now that was some on a full year basis. It was 45 crores. So if you add that, we are then talking about close to 450 crores, and then the growth is about 10%.
Okay. No, but this quarter it was about 140 crores, right? So is that the base one can look at going forward, or in FY25 as we see?
Yeah, base would be broadly that, or you will just definitely see some bit of increase because both the CV business and the HFC business, they are increasing in size, and therefore there is a need to ensure that the branches go up, the number of employees go up. So all those things will definitely mean that the OPEX will go up, may not go up in the same ratio as the revenues, which will grow much faster.
So maybe close to about 600 crores one can expect, right, on an absolute level.
Yeah, you can say 550 to 600, that range.
Fair enough. And my second question revolves around your growth and ROA that we see for FY25. So any kind of light you can throw on that?
I think we have said two things, maybe over the last 5 quarters, that we will do about 4,400 crores of disbursement. Now I'm talking about the standalone business. We'll do about 4,400 crores and we will do 6,000 crores in the next year. 4,400 crores is what we have done. We'll do about 6,000 crores. Now that most of the one-offs are away, we believe that ROA will start inching up. So we are pretty confident of the ROA going to improving significantly from the 0.9 that we have reported in the current quarter and on a full year basis.
So I think earlier we have been speaking about 2 to 2.5% kind of a ROA, right? But that looks difficult, correct? I mean, for FY20.
2.5% could be more of a 2% would be more of a 26 phenomena.
Correct.
25, I believe that we would be happy if we are in the 1.3 to 1.6% range. See, one thing that we need to understand is RBI has had actually come up with a circular basis which the interest costs did go up, and that has actually led to some bit of increase in cost. Correct. Number one. Number two is we also mentioned about the ARC transactions that we did, which reduced the income. So that also has an impact on the, all these have an impact on the ROA. So because of that, the ROA looks to be slightly subdued, but then there are numbers which are firm and which will continue to improve as we go forward.
Understood. And on the AUM part, I mean, what is the AUM growth we are looking at? I mean, I think on a console level, I think we are at about 8,700, 8,800 crores, right? FY24. So what we may look at in FY25?
We believe that we should win that housing finance should do about 3,000 should be their book, and in case of the standalone, we should be in the range of about 7,500 to 8,500 to 9,000.
So around 11,500 to 12,000 we might target, right?
11,500 to 12,000.
11,500 to 12,000. Fair enough. I think that's it from my side. Thank you so much. All the very best.
Thank you. Next question is from the line of Ketan Athavale from Robo Capital. Please go ahead.
Thank you for the opportunity. Sir, I wanted the guidance figure for FY26 on our AUM, and our guidance is on, NIS, cost to income and credit cost for the next 2 years.
Ketan, good afternoon. Thanks for being on the call. We had said that maybe in 26 we will do a disbursement of about 7,500 crores in the standalone, and on an overall basis of about 10,500. We may not want to currently give any guidance for any other numbers in relation to FY26. We would want to see how the year pans out before we start giving any guidance.
Okay, but can you give the figures for FY25?
No, I think I mentioned about the ROA. I said that it would be in the 1.3 to 1.6% kind of range for the current year. However, that is FY25.
Okay, got it. Thank you.
Thanks.
Thank you. The next question is from the line of Parikshit Kabra from Picardy Advisors LLP. Please go ahead.
Hi, thank you for taking my question. I was hoping for the standalone, the credit cost that you have shown of 102 crores, can you break it down between business as usual and your legacy book?
The 102 crores contains the extra provision which we have on the SRs also.
102 crores is a combination of two, largely a combination of two numbers. The others are, I would say, business as usual. We mentioned about a one-time income gain that we got, and that was utilized for creating provisioning for the security receipts. So that was 75 crores. On a conservative basis, we made an additional provision of roughly 26 crores on the corporate loan book.
Correct.
So that is about 101 crores. The others would be some pluses and some minuses, but then broadly that's the number for the quarter.
Got it. So whatever is remaining is for the business as usual, the ongoing loans or loan book.
Yeah.
Right?
Some reversals happen, some additional provision happen, when a huge disbursement, 1465 crores of disbursement, so that will take away
some amount of stage 1 provision is also there.
You need to create provision. So that's a continuous process.
Got it. So now that we still have about 500 crore SME loan book and a 400 crore corporate loan book, should we assume that now all overhangs have been accounted for, or at a later point we might still want to increase the provision?
See, corporate is all real estate. We have appraised, assessed, and felt like there is no further need that will be required to go on. So that's on the corporate. The SME book, most of it is the DAPTC which is there, which I am holding in my balance sheet. So we are adequately provided there. So we don't feel any extra that is coming in.
The 485 crores or close to 500 crores of SME, out of that the own book, I would say, which is my own, is 46 crores. The on the book, which is including the PTC, it is a total of 316 crores. So the balance of about 170 odd crores is the DA, which we report as a part of the AUM, but strictly not a part of my book, on which we have no liability as such, except for collection.
Got it. And I'm sorry, you answered this question just now, but did you give a guidance for ROA for FY25 or ROE or ROA, either of them?
I mentioned about we are hopeful of a 1.3 to 1.6% ROA.
For FY25, right?
Yes.
Perfect. All right. Thank you so much and good luck.
Thanks, Parikshit.
Thank you. The next question is from the line of Anant Mundra from My Temple Capital. Please go ahead.
Hello. Thank you for the opportunity. I just had one question. So what is our collection efficiency excluding the overdue accounts? Excluding the overdue collections?
EMI to EMI collections on the CV book is at around 93%. We were probably 2 years back, if you had attended the call, we were at around 84%. Now it has moved up to 93%. That's because we have changed the processes. I think last call we explained the detailed process around how we have improved our EMI to EMI collection. We are working on so that this can get improved further.
So what is the number that we'll be comfortable with or we're targeting to get to on the collection?
The profiles which we are dealing with, 92 is a good number, but we always keep pushing for a higher thing.
Okay. And sir, what would this number be for the housing finance subsidiary?
So on an EMI to EMI basis, it will be about 95%. And including overdues, we would be about 99%.
Okay. All right. That's it from mine. Thank you.
Thanks, Anand.
Thank you very much. In the interest of time, that will be the last question. I will now like to hand the conference over to Mr. Viral Shanklecha from Orient Capital.
Thank the management for taking the time out for this conference call today, and also thanks to all the participants. If you have any query, please feel free to contact us. We are Orient Capital, Investor Relations Advisors to Indostar Capital Finance Limited. Thank you so much.
On behalf of Indostar Capital Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.